Something changed this week that could quietly affect your savings account, your mortgage payment, your credit card bill, and even what you pay at the grocery store. And most people have no idea it happened or why it matters to them personally. I want to walk you through exactly what this means for your money, your retirement, and your daily life. Because the financial news right now sounds complicated, but what's actually happening is something every household in America needs to understand. Kevin Warsh has just been confirmed as the new Federal Reserve Chair, replacing Jerome Powell. And before you click away thinking this is just political news or something only Wall Street cares about, stay with me for just 2 more minutes, because by the end of this video, you're going to understand something that most Americans genuinely don't, and that understanding could protect your financial future. If you're getting value from this channel, now is a great time to subscribe and hit that bell, because we talk about exactly these kinds of money issues every single week, the things that actually affect life after 50. So let's start with the basics, because a lot of people hear Federal Reserve and their eyes glaze over. The Fed is essentially the most powerful financial institution in the United States. It doesn't set your mortgage rate directly. It doesn't control gas prices directly, but it sets the overall tone of borrowing in this country. When the Fed raises interest rates, everything gets more expensive to borrow. When it lowers them, borrowing gets cheaper. That simple dynamic touches your credit card, your car loan, your home equity line, your savings account, and indirectly, the prices you pay for almost everything. Jerome Powell had been leading the Fed through one of the most difficult inflation battles in decades. Now Kevin Warsh steps in, and he's stepping in at a moment that is honestly one of the most economically sensitive we've seen in years. President Trump has been vocal about wanting lower interest rates. And look, when you hear that, it's easy to understand the appeal. High interest rates are genuinely painful for millions of Americans. If you're carrying credit card debt right now, you might be paying 22%, 24%, even 27% interest. That means every payment you make is mostly going to interest before it ever touches your actual balance. If you're trying to buy a home for a child or grandchild, or if you yourself are looking to downsize and move, the mortgage rates right now can make those numbers look impossible. If you're a small business owner, borrowing to cover inventory, equipment, or a slow season has become significantly harder and more expensive. So the idea of lower interest rates sounds like relief, because for a lot of people, it genuinely would be. But here is where things get complicated. And this is the part that I really need you to understand, because what's happening right now in the economy is sending mixed signals that make the Fed's job incredibly difficult. On the exact same day that Warsh was confirmed as the new Fed chair, a major economic report came out, the Producer Price Index, and it did not look good. Producer prices rose 1.4% in just 1 month, April alone, and they were up 6% compared to the same time last year. That is the largest monthly increase since March of 2022, and the biggest yearly increase since late 2022. Those are not small numbers. Now, I know Producer Price Index sounds like something economists argue about in conference rooms, but let me translate it into plain English because it matters for your life directly. Producer prices are what businesses deal with before the product ever reaches you. Think of it as the price of making things, shipping things, fueling things. Before the grocery store marks up that box of cereal, the company that made it already paid more for wheat, more for fuel to ship it, more for the packaging. So producer prices are like an early warning system. They show us what's coming before it hits your shopping cart. When producer prices spike, businesses have a few choices. None of them good. They can absorb the higher costs and accept lower profits. They can raise the prices you pay at the register. They can cut corners somewhere else, maybe lay off a worker, reduce hours, or stop investing in the business. Or they can just delay everything and hope costs come down. Eventually, those pressures find their way to consumers. Not always immediately, but they do. And April's report showed energy prices leading the charge. Goods prices up 2% in 1 month, energy overall up 7.8%, and gasoline alone up 15.6% in a single month. Gasoline matters so much because it's not just what you pay at the pump, it's what every truck driver pays to deliver your groceries, your medication, your packages. When fuel costs more, everything costs more, because energy is woven through almost every transaction in the economy. So here's the tension that Kevin Warsh is walking straight into on day one. On one side, there's political pressure and real economic hardship, pushing for lower interest rates. On the other side, inflation data is still running hot, and cutting rates too soon could make that worse. This is genuinely hard. And I don't say that to defend anyone politically. I say it because understanding the difficulty helps you make better decisions with your own money. Here's something I want you to really hold on to, because I see a lot of confusion about this online. When people hear that inflation is slowing, they expect prices to fall. They expect to go back to what things cost 2 or 3 years ago. But that is almost never what happens. Lower inflation means prices are still going up, just not as fast. Think of it like climbing a staircase. Inflation is how quickly you're climbing. Slowing inflation means you're climbing a little slower. It does not mean you walk back down the stairs. So if your grocery bill went from $100 to $120, slower inflation might mean it goes to $122 instead of $128. It does not go back to $100. For families who are already stretched thin, that distinction is everything. The prices that feel painful today are very likely going to be the new normal, and that's what makes managing money right now so important. So what can Warsh actually do? What does a new Fed chair realistically change? A few things. First, the tone. The Federal Reserve Chair is the public face of the central bank, and the words he chooses carry enormous weight. If Warsh signals openness to cutting rates, financial markets start pricing that in. Mortgage lenders, banks, bond investors, they all start adjusting. Sometimes the Fed's language shifts market conditions, even before any official rate change. Second, Warsh can try to build consensus inside the Fed for a different direction. But the Fed doesn't work like a monarchy. Interest rate decisions are made by a committee, the Federal Open Market Committee, which includes other governors and regional bank presidents. The chair has real influence, but it is not a one-person decision. Third, he can reshape the long-term culture and priorities of the Fed, how it thinks about inflation risk, how it weighs job market concerns, how it communicates with the public and the markets. Those things matter over time. What he cannot do, and I think this is important to say clearly, is wave a wand and make gas prices drop. He cannot call grocery stores and tell them to lower their prices. He cannot force your credit card company to cut your interest rate next month. The Fed is powerful, but it works slowly through the entire financial system, over months and sometimes years. Now let's talk about what this means for different groups of people, because not everyone experiences interest rate changes the same way. And this is especially true for those of us in the Life After 50 community. If you are a saver, if you have money in CDs, money market accounts, or high-yield savings accounts, the higher interest rates have actually been good for you recently. For years, your safe savings paid almost nothing. A savings account earning 4 or 5% felt unimaginable after a decade of near zero rates. If Warsh steers the Fed toward lower rates, those yields will eventually come down. Banks will lower what they pay on deposits. That may not happen overnight, but it will happen. For someone living on interest income in retirement, lower rates can feel like a pay cut, because in a real sense, it is. Your purchasing power on that income shrinks. On the flip side, if you are a borrower, if you have credit card debt, a home equity line of credit, an adjustable rate loan, or you're hoping to refinance, lower rates would eventually offer some relief. But I want to caution you here, because this is where people make financial mistakes. Even if the Fed cuts rates, your credit card rate does not automatically drop to something manageable. A small Fed rate cut does not turn a 24% card rate into a 10% card rate. And if markets believe the Fed is cutting too soon while inflation is still running, long-term interest rates could actually stay high because investors demand more return to protect against the inflation they're worried about. So please, do not build your monthly budget around the assumption that rates will fall quickly and fix the problem. Pay down high-interest debt where you can. Avoid taking on new variable rate debt unless you have to. And only refinance if the math truly makes sense for your situation, not because rates are slightly better. For Social Security recipients and retirees on fixed income, this period is especially important to watch. Your costs are rising right now: groceries, gas, insurance, utilities, medical expenses, and they are rising faster than a lot of people planned for. The cost of living adjustment for Social Security is helpful, but it comes later, and it's calculated in a way that may not reflect exactly what you spend money on. A hot producer price report, like the one we just got, doesn't automatically mean the next COLA will be dramatically higher, but it does feed into the broader inflation picture. If businesses pass those higher costs on to consumers over the next several months, consumer prices could rise during the months that are used to calculate next year's adjustment. But the key word there is later. The bills arrive now, the adjustment comes after, and that gap between when inflation hurts you and when your income catches up is the painful part that a lot of retirees know all too well. There's also a political dimension to this that's worth acknowledging, even if it's uncomfortable. The Federal Reserve is designed to be independent from political pressure, specifically because it sometimes has to make unpopular decisions. Raising rates to fight inflation makes borrowers angry, upsets markets, frustrates politicians. But if the Fed cuts rates too soon and inflation roars back, the damage to everyday Americans can be far worse and far longer lasting. People who support Warsh's appointment might argue that Powell kept rates too high for too long and that a new direction is overdue. Critics worry that the Fed under Warsh could become more responsive to political pressure than to economic data, and that independence, once eroded, is hard to rebuild. Both of those concerns deserve honest consideration. When people lose confidence that the Fed will keep inflation in check, That loss of confidence itself becomes an economic problem. It feeds into how wages are negotiated, how businesses price their products, how investors evaluate risk. Credibility is not just symbolic. It has real economic consequences. So, what is the most realistic path forward? If inflation cools on its own and the job market softens a bit, Warsh may have the room he needs to begin lowering rates, and that would genuinely help borrowers, homebuyers, and rate-sensitive parts of the economy. But if inflation stays elevated, he faces a credibility test almost immediately. Cutting rates, while prices are still rising fast, would risk making the inflation problem worse. Holding rates steady would frustrate the administration and disappoint millions of people who are counting on some relief. The most likely outcome may be what you could call cautious patience, signaling that lower rates are possible down the road, but only if the economic data actually supports it. And honestly, that's probably the right message for households too. This is not a moment to make dramatic financial moves based on what you hope the Fed will do. It's a moment to understand what's actually happening, protect what you have, and make decisions based on the numbers in front of you, not the numbers you're hoping for. Here's the bottom line. A new Federal Reserve Chair is significant. Kevin Warsh taking over from Jerome Powell is a real shift in direction, in tone, in philosophy, potentially in policy. But it does not erase inflation. It does not guarantee lower rates are coming quickly. And even if rates do come down, that doesn't mean the prices you're paying at the store, the pump, or on your insurance bill go back to where they were. For savers, watch your deposit rates over the coming months. For borrowers, watch your loan costs, but don't assume instant relief. For retirees and those on fixed income, keep paying close attention to inflation because your purchasing power is the real issue at stake. And for everyone, remember that the difference between prices falling and prices rising more slowly is a very big difference. A new chair can change the direction of policy, but your household budget still depends on the numbers that show up every month in your bank account, on your bills, and at the checkout line. If this video helped you understand what's happening with the economy right now, I would really appreciate it if you gave it a like. It helps more people find this channel, and honestly, this is exactly the kind of information that more people need to hear. Drop a comment below and let me know. Would you rather see lower interest rates right now, or would you rather see prices actually come down first? I read every comment, and I will reply. Share this video with someone you know who is trying to make sense of what's happening financially, because understanding this stuff is how you protect yourself, and I will see you in the next one.